the leaves are changing color and the temperatures are cooling down, which means fall must be upon us. How's everyone doing out there today? This is Andrew with the Andrew Smith team at eXp Realty with my monthly market report for the month of November 2020. It seems like we've touched on this every single month in how strong the real estate market has stayed with regards to sales. I mean, the spring kind of shifted into the summer, and the summer has shifted into the fall, and it hasn't really showed much signs of slowing down. And the numbers for October prove it. It's still moving very, very rapidly. So I've got a bunch of things to go through with you today. So I'm going to jump right into that. And we're going to break this monthly market report up into a couple of different areas. So one, we're just going to kind of give an overview of what's going on in the economy right now. We'll then look at what those economic numbers mean specifically with regards to housing. And then we'll jump in at the end there on home prices, what's going on now, what's driving them, and what we think are going to, or what we think is going to happen in light of the election. So to start off with this month, it's a question of going back to April. And the reason I want to go back to April is that I've mentioned in the past that when the virus hit, when we went under lockdown as a result of the coronavirus, many of the major financial institutions were calling for a V-shaped recovery. And from that information, that's what I was reporting. And I'll be honest with you, I got quite a lot of pushback. I had some comments. I had some people message me privately and said, "You're looking at things through rose-colored glasses. This isn't what's going to happen. This is going to be the worst recession since the Great Recession. Unemployment's like the Great Depression. This is going to be horrible." And again, I was just trying to provide information, relay the information as I was receiving it. And this is what the major financial institutions were calling for. They were talking about a V-shaped type recovery. Now, I bring this slide up from April in order to reference that on where we are today. So the top slide now is April, and the bottom slide is actual as of quarter 3. So were they rose-colored glasses? So it's hard to say. And do I indicate that we're out of the woods? No, by no means. And I'm going to touch on that in just a second. But the point is that the actual that we've seen so far is completely matching what was forecast by the major financial institutions. But when you throw another factor in there, as is pointed out here by a national economics correspondent at the Wall Street Journal. News stories often describe the coronavirus-induced global economic downturn as the worst since the Great Depression. Yet for many, the comparison does more to terrify than to clarify. And, without going off on a tangent here, I mean, let's face it, the media itself sells sensationalism. If it's not sensational or overly negative, it doesn't sell, right? So they don't report it in the same way. Am I suggesting that the virus isn't bad? By no means. You've got something that has killed over 200,000 Americans and many, many more around the world. That's something to be taken seriously. But at the same point in time, I think we have to look at it and say, okay, many of the stories, the way they're being presented, are sensationalizing it. Has coronavirus touched me personally? Not in the way of death, no. And no one I know. But my daughter's had to be tested a couple of times as people she hung out with on Halloween and play soccer with have tested positive. Their whole families, as a result, tested positive. She never has. We haven't. My son's at Texas A&M. He's had to be tested many times, been negative every time. And most of the people I know have had flu-like symptoms for a couple of days, 2, 3 days, and then have felt better again. And I only bring that up not to say that it's not something that we shouldn't be concerned about, just to say that it doesn't touch everyone in the exact same way, right? And there are many people with different conditions that have been impacted much more. And as the medical community has learned how to treat the virus more, we've seen that death rate come down. But again, I'm not saying that it's not important, and I'm not saying that we should just say, oh, look, everything's fine. That's not the intent here. More just to say how things are often reported. And, with what's being reported and the economy, I think it's important to look at the fact that we talk about record unemployment. We talk about all the people receiving unemployment benefits. That in turn has led to forbearances. It's had many talk about a wave of foreclosures, which we're going to touch on a little bit later. But here's what hasn't been reported in the news: new business applications. These are people filing new business applications. Look at look at this. In 2020, look at that line. Many of the most successful companies we see today were launched in the Great Recession that we experienced in 08, 09. Right? They were born out of that. Many of the people now that have been forced to work from home, it's the same thing. They're coming up with new ideas, new ways of doing things, and the amount of new businesses being started is astronomical. I mean, it's virtually a straight line up. And that's something that hasn't been reported, but is something I wanted to touch on. Now, going directly to unemployment, it's still moving in the right direction, right? I mean, that's the important thing. Are there too many people unemployed? Yes, there are. But when you look at the fact that by May, we had nearly 25 million unemployed, and right now we're down to about 7.3 million currently receiving unemployment insurance, it does just show that the trend continues in the right direction. That doesn't mean it's perfect. That doesn't mean it's over, but it means we're moving in the right direction. And that's the thing I really want to point out here. But at the same point in time, I do want to be sensitive and realize the fact, as I just mentioned, that we're not out of the woods. So even the Federal Reserve here just recently, data from the Survey of Business Uncertainty, SBU, suggests that the road forward is going to be a tough slog. Businesses hold tepid expectations for year-ahead employment and sales growth. And based on the latest average projection, it will take firms more than 4.5 years to recover pre-COVID employment levels. So again, that's not really a change. Even back in April, many of those same leading financial institutions were forecasting that it could take us 4 to 5 years to get back to the level of unemployment that we saw pre-COVID. That's still the same. Nothing there has changed. So we do have a long road ahead. But the important thing is that we're moving in the right direction based on all of the data that we've seen so far. Yes, we've just had an election. Yes, there's uncertainty in that, and that uncertainty can lead to many people freezing. And we'll touch on that in just a minute as well. So, what does all of this mean for housing? Well, early on, when people lost their jobs, the number of forbearances jumped up. And a forbearance is a situation where people are basically given a break on their mortgage. The idea is that the plans in place were not sufficient so that people would recover. The idea was, oh my gosh, lump sum payments are due in 90 days. They're only being given 3 months worth of relief. And that this is going to lead to a massive foreclosure crisis. My viewpoint and take on that after going through the last foreclosure crisis was not so fast. Let's give all of this time to settle. Let the dust settle, so to speak, and let's see where all of this starts to shake out. And here's what we're seeing right now. So with regards to forbearances, the number of mortgages currently in forbearance continues to decrease. We went from nearly 8.5% of all mortgages in May down to 5.83% of mortgages here in October. So let's look at some actual numbers against that. And I think this chart is very compelling. Of the 5.7 million families granted forbearance, here's what happened when the original plan, that original 90-day plan, expired. It ended. So the forbearance was extended for nearly 2.4 million. So for 2.4 million, the CARES Act came out. Different elements of that were in place to help people. And the number of homes in forbearance, they were able to say, we're still in trouble. We still need help. and those forbearances were extended. 2.3 million homes, they were removed from forbearance. They applied for forbearance, it was granted, they were in there, and they got their work back. They were able to recover, find other employment, or got their previous employment back, and they're performing loans. They're back exactly where they should be, right? So they're making their payments and they're not behind. 500,000 mortgages have been paid off. Chances are, I'm not thinking somebody just suddenly got a windfall of cash for the vast majority. I'm going to guess most of those homes went up for sale and have sold. As we all know, home sales are up. So those are probably people that realized it may not go the way I want it to, so I'm going to get out. And they were able to pay that mortgage off. There's 481,000 that are expired, and they didn't have their forbearance extended. They are actively in a loss mitigation. That could be a loan modification. It could be renegotiating a different type of forbearance. They're basically in a workout plan with a lender. 80,000 homes actually expired delinquent and are in the foreclosure process. But I wouldn't exactly call 80,000 homes a foreclosure crisis. We see right around 1% of all homes sold in the country on an annual basis sell through foreclosure in any market, right? Good and bad. So is there an uptick in foreclosures? Yes. Is it a tidal wave coming that's going to crash the real estate market? Not from what anyone is forecasting right now. So again, as we look at this, it's important to remember that in many cases, home equity has played a huge part, which we didn't have in 08 and 09. Right now, people have equity in their homes, which means they have options to pay it off, to do other things other than just go to foreclosure. And prices, as you know, continue to rise. So why do they continue to rise? Supply and demand. Demand remains high. It has continued to remain high throughout the entire process. If anything, the pandemic has made people realize that their current home situation doesn't work. They need an extra space for school. They realize that work from home is becoming more permanent and they need a space from that. It has actually fueled the need for different type of housing, right? So that's kept demand high. How does that play out? Well, look, this is a national average right here of where we are with regards to inventory, which is supply. 2.7 month supply nationally as of the end of September. Okay, keep in mind that 6 months is considered a balanced market. Now, if we look specifically at the markets my team serves in Texas and Southern California, it's a little bit different. I mean, in Frisco, Texas, where I'm actually based, supply is down 62% to 1.4 months worth of supply. Home prices are up 5.4% year over year. In Prosper, Texas, also where I work, prices are up 11.3% year over year. Supply is down 75.6% to 1 month. That's 30 days. 30 days is all. Okay. Temecula, California, Southern California, where we also operate, median sales prices are up 14.1% year over year, and supply is down 37%, 1.7 months. So well below the national average in the markets where I directly work. So that's what we're seeing. What's the result? High demand, low supply. It's forcing pricing up. So where is the supply, right? Why aren't homeowners putting their homes up for sale? And a recent survey by Zillow Group showed for many, 34%, it's actually uncertainty. They're uncertain about the future. And as we know, uncertainty can cause people to freeze. You don't know what's going to happen. So until you do know, you do nothing. You just kind of tread water and wait and see. It's very, very natural situation, right? So Jeff Zucker, here's what and he's the senior economist at Zillow. Here's what he had to say. Homeowners who feel life is uncertain right now may think they can still get a strong price if they delay selling until they have more clarity. The catch is that waiting to sell may raise the cost of a trade up. This fall's record low mortgage rates, which make a trade up more affordable on a monthly basis, are not guaranteed to last. So, with that in mind, you have to always consider that there's pros and cons to all of it. What I'm trying to do here is provide you the information that you can have to make the best decision for you. And that decision's not going to be the same for everyone. But those that wait, there's going to be a cost in waiting in many instances. Is it going to be a big cost? Maybe, maybe not. But if home prices continue to go up and you're considering selling and moving up to a larger home, imagine your home now is worth 300,000 and the home that you're planning to buy is 500,000. If home prices go up 10%, right? Your $300,000 home goes up to 330. The $500,000 home goes up to 550. You look at interest rates in that and they tick up, it changes affordability. It changes. So there becomes a cost associated with waiting that's pointed out here. And with regards to home prices, again, I just let you know what they've gone up year over year in the markets where I directly work. Here's where many of the top forecasting companies are forecasting. Zillow has now revised their price up to 7%. They're expecting to see nationally 7%, all the way down to CoreLogic on the low part, 0.2%. That's important though, because originally they were forecasting a 6.6% decline in home prices. So that's a big swing for CoreLogic. But I'm waiting to get more information to understand why their forecast is still so low compared to everybody else. So let's look at mortgage rates. Okay, I bring up mortgage rates because obviously low rates of what have fueled a lot of demand. They've been crazy, crazy low, something that I haven't seen. No one has because they're record lows. And the funny thing is if they start to go up, people will think that they've missed the boat, understanding that historically these rates are still crazy good. Here's where the Mortgage Bankers Association forecasts rates to go over the next few years. It's not a huge change, but they are forecasting rates to go up to about 3.3% next year, then 3.6, then 3.9. So almost a full percent over the next 3 years. Now, when rates go up a full percent, your buying power goes down 10%. Okay, so I'll say that again. If interest rates go up 1%, all else being equal, your purchasing power goes down by 10%. If home prices appreciate by 5% a year for 3 years, home prices will have gone up 15% over that time period, more in some markets. If interest rates go up by 1% in that time frame, your purchasing power will go down by 10%. That's a 25% swing. There's that cost of waiting. So again, where's it going to go? I don't know. These are what the forecasts are saying. And again, in order for you to make the best decision for you. But where is it in terms of affordability? So far, affordability caused by the low interest rates have kept that price in check. So even though prices have gone up, houses haven't become unaffordable. So let's look at this. It's important to remember on this graph that we're looking at right here is that the higher the number, the more affordable homes are. And you can see now with prices increasing what they have in the last year, affordability is actually down slightly from where it was a year ago. And the last month was the first month we saw a month over month decline in home affordability, which by no means issues a trend, but it does start to show that we are reaching the point where home price appreciation is starting to surpass the offset being caused by low interest rates. And Mark Fleming, the chief economist at First American, says the good news is that affordability remains significantly higher than 1 year ago, mostly due to falling rates. 1 month does not make a trend, but this month's decline in affordability signals the current dynamics producing faster house price appreciation may begin to erode the affordability gains of recent years. And I think that's important to keep in mind. So all we know is that for next year, regardless of the election and anything else, housing still looks good. The fundamentals still look very, very strong for housing. The demand for housing is still high. So we're forecasting prices are going to continue to increase. As interest rates go up, affordability will get hit a little bit. Affordability will come down slightly. To offset that, I think what we're going to see is more people moving further out. right? More away from the population centers because of the fact that the work at home environment that is now our current reality, I don't think it's going away anytime soon. So people aren't needing to commute every single day. They aren't needing to be in the office. And that changes where people can live. It's kind of interesting because Upwork recently did a survey of all people that are considering a move. Here's what they found. How far away are you considering moving? 41.5% of the people that were considering a move were considering a move more than a 4-hour drive from where they live currently. People aren't going to think that way if they're commuting every day. You're not going to spend 8 hours commuting, right? So this is kind of showing that that trend to move away, to further away, focusing in on lifestyle is increasing. Doesn't mean the cities are going to be empty or the main population centers are going to be empty, but it's just saying that some of those outlying communities, you're going to start to see an increase in the number of buyers. I was talking to a real estate friend of mine in Hawaii on Maui, and he was saying they're seeing a huge influx in buyers from Northern California, Silicon Valley, because they can work remotely. They're now going to go live in Maui while they're doing their work back on the mainland, which doesn't exactly sound too bad. I'm sure many of us would possibly consider that if it worked out. So anyway, that's going to wrap it for the real estate market update for November. Hopefully it helps. It's just kind of a deeper dive into some of these numbers, trying to dig into what they mean and what we're likely to see going forward. It's going to be different for everyone's situation. And if you've got questions about your specific situation, please reach out. I'm always happy to talk to you. Never any obligation to do that, and just hopefully give you a different viewpoint so that you can make the best decision for you and your family going forward.